$59.32. That is the number that will be etched in history books. Yesterday, December 6th, 2025. Silver shattered every record in history. But if you are just looking at the price, you are missing the real story. The real story is not about the number on the screen. It is about what happened behind the screen while the price was exploding. While algorithms were firing thousands of trades per second, the CME Group, the exchange that handles these derivative contracts, reportedly went down. They issued a statement calling it a server cooling issue, a technical glitch. But I have been in this market for a long time, and I know that in finance, there are no accidents. There are only consequences. For over 10 hours, the digital price feed went dark. But behind the scenes, the panic was absolute. When the systems finally came back online, market observers witnessed something that should not happen in a healthy market. The bid and ask spread. The difference between what buyers want to pay and what sellers want to take was over $1 wide. Now, to the average person, that might not sound like much, but in the world of high-frequency trading, where fortunes are made on fractions of a penny, a $1 spread is not just volatility, it is a heart attack. It is the definition of illiquidity. It means the market makers, the entities responsible for keeping the oil in the engine, stepped away. They refused to sell. Why? Because they know what is coming. And look at the lease rates. In October 2025, just 2 months ago, reports showed silver lease rates hit approximately 30% annualized. Let me explain what that actually means. Usually, lease rates are near zero because there is plenty of metal sitting in vaults doing nothing. But 30%? That means industry players, refiners, manufacturers were so desperate for physical silver immediately that they were willing to pay 30% interest just to borrow a bar of silver for 1 year. That is not speculation. That is a scream for help. That is the sound of a supply chain snapping. And right in the middle of this chaos, while retail investors were celebrating the price hike, JPMorgan made a move that went almost unnoticed. According to COMEX filings, they reclassified approximately 134 million ounces of silver. They moved it from registered status to eligible status. This is a critical distinction. Registered silver is the inventory available for delivery against futures contracts. It is the silver that backs the paper price. Eligible silver is just metal sitting in a vault. It is private property. It is not for sale. It is not available for delivery. Think about the timing of this. Precisely when the market was screaming for liquidity, precisely when lease rates were skyrocketing, the largest holder of silver in the world pulled roughly 9% of the global deliverable supply off the table. They took the ball and went home. Why would they do that? Why would they drain liquidity during a crisis? Unless they want the crisis to get worse. This brings me to the 4 stages of a financial collapse. I have studied every major crash since 1929. They all follow the same script. Stage 1 is the setup, where the illusion of stability is maintained. Stage 2 is the expansion, where debt and paper promises overwhelm reality. Right now, we are watching Stage 3 unfold in real time. Stage 3 is the break. This is the moment where the paper promises fail, and everyone simultaneously demands the real asset, but there is not enough to go around. Part 2, the accumulation of 14-year strategy. To understand why this is happening today, we have to go back. We have to look at the architect of this entire scenario, JPMorgan. For years, the internet has been full of theories about price suppression, about manipulation, but we do not need theories anymore. We have the data, and the data paints a picture of one of the most patient and calculated trades in financial history. It started back in 2008. During the great financial crisis, JPMorgan acquired a failing bank called Bear Stearns. When they bought Bear Stearns, they did not just get their buildings and their employees. They inherited their positions. And Bear Stearns was massively short silver. They were betting the price would go down. For the next few years, JPMorgan was reportedly stuck on the wrong side of the trade. But then, around 2011, something changed. Industry sources suggest that the bank made a strategic decision. They decided not just to exit the short position, but to become the biggest long position holder in history. But here is the problem. How do you buy hundreds of millions of ounces of silver without sending the price to the moon? If you or I go to buy a few coins, it does not matter. But when a whale the size of JPMorgan buys, they move the market. So you have to be clever, you have to be patient, and you have to be ruthless. From 2011 through 2024, we watched a strange phenomenon. Every time silver tried to break out, every time it hit $30, it would get slammed back down. Usually at times when the US market was closed, or during periods of low liquidity, huge sell orders of paper silver would flood the market, crushing the momentum. Traders called it the slam. Regulators called it normal market function. I call it accumulation. Because while the paper price was being smashed, the physical metal was moving. It was moving into JPMorgan's vaults, according to various market reports and inventory tracking, since April 2011. They have accumulated what some analysts estimate at 675 million ounces of physical silver. Let me put that number in perspective. Global mining production is roughly 800 million ounces. That means one single bank reportedly holds nearly an entire year's worth of global production. That is more than the Hunt brothers held in 1980. That is more than Warren Buffett bought in 1997. It is roughly 45% of the world's identifiable above-ground supply. Why would the most sophisticated bank in America spend 14 years hoarding a metal that economists said was a barbarous relic? Why would they face lawsuits? Pay nearly $1 billion in fines for spoofing the market? If the prize was not worth it, the answer is simple. They knew what was coming. They knew that the dollar has an expiration date. They knew that the debt levels were unsustainable. And they knew that eventually the world would run out of cheap silver. They were not suppressing the price to keep it low forever. They were keeping it low so they could buy it all. And now, in December 2025, it appears they are finished buying. They have flipped the switch. They are no longer the seller of last resort. They are the holder of last resort. And when the largest supply source stops selling and starts hoarding, the price has only one direction to go: vertical. Part 3. The broken mechanism. Paper versus physical. But JPMorgan is just one piece of the puzzle. To truly understand the violence of this move, you have to understand the mechanism of the market itself. You have to understand the lie. For 45 years, since 1980, the price of silver has not been set by the exchange of physical metal. It has been set by the exchange of paper contracts, futures, options, derivatives. This system was designed to create liquidity, to help miners and farmers hedge their risk. But over time, it mutated. It became a casino. A casino where the house sells more chips than it has cash in the vault. Here is the math that scares me. According to published COMEX data, the open interest, which is the total number of paper contracts active in the market, sits at approximately 244% of vaulted silver. But that includes the eligible silver, the silver that is not for sale. If you look strictly at the registered silver, the metal that can actually be delivered, the ratio is terrifying. Some analysts estimate there are over 50 paper claims. For every one single ounce of physical silver available for delivery, think about that. Imagine a parking lot with 100 spaces, but the owner has sold 5,000 parking tickets. Everything works fine, as long as everyone does not try to park on the same day. But what happens when there is a panic? What happens when everyone shows up at once? That is what we call a short squeeze. And this is not just a theory. We saw a preview of this with the nickel market in 2022. The London Metal Exchange actually had to cancel trades and shut down the market because the price went vertical. But the silver market is much bigger than nickel, and the implications are much more dangerous. Because silver is not just an industrial metal, it is money. It is a monetary asset. When people lose faith in the currency, they run to gold and silver. And in this run, the paper market becomes a trap. Those holding paper contracts, thinking they own silver, are going to receive a rude awakening. Read the fine print of these ETFs and futures contracts. In the event of a force majeure or a market failure, they are not obligated to give you metal. They can settle in cash. They will give you a check for the last traded price. But what good is a check if you cannot buy the metal with it? If silver is trading at $100, but there is none available, your paper contract is worthless. This is the decoupling, the separation of the paper price and the physical price. We are already seeing it. Dealers are reporting premiums of 40 to 50%. If you want a 1-ounce eagle, you are not paying $59. You are paying $80, maybe $90. The paper price is becoming irrelevant. It is becoming a ghost number, a relic of a system that has already died. But the body has not hit the floor yet. Part 4, the industrial vacuum, the inelastic demand. Now, let us add the fuel to this fire. If this was just about investment demand, maybe the banks could manage it. Maybe they could print more paper and scare investors away. But this time, it is different. Because this time, the buyers are not just speculators. The buyers are industries, and they do not care about the price. This is what economists call inelastic demand. Let me give you a specific example. Take the latest generation of solar panels. The new technology, called TOPCon and HJT cells, they are more efficient, but they require significantly more silver, roughly 50 to 80% more than the old panels. Solar manufacturers cannot substitute silver. It is the most conductive metal in the universe. Standard physics dictates it. Without silver, the panel does not work. Now, consider the cost structure. Silver makes up a small fraction of the total cost of a solar panel, maybe 10%, if silver goes from $30 to $100. Does Apple stop making iPhones? Does Tesla stop making cars? Does the solar industry shut down? No, they cannot stop. They have factories to run. They have government mandates to meet. They simply pay the price. They will pay $100. They will pay $200. Because the alternative is going out of business. And look at the growth curves. 5G technology. Every tower, every station needs silver. Electric vehicles. Depending on the model, an EV can use up to 2 ounces of silver. That is 3 times more than a gas car. And then there is the monster in the room. Artificial intelligence. AI data centers. The demand for high-performance computing chips is exploding. These chips require the absolute best conductivity. They cannot use copper. They must use silver and gold. Industry reports now suggest that industrial demand alone is consuming roughly 59% of total annual supply. But here is the catch. Most of this silver is consumed. It is gone. When silver is used in a missile or a tiny amount in a microchip, it is not economically viable to recycle it yet. It ends up in landfills. It is lost forever. So we are burning the candle at both ends. We are consuming more than we mine, and we have been doing it for 7 consecutive years. This is called a structural deficit. Data from the Silver Institute and mining reports show that mine production peaked back in 2016. It has been declining or flatlining ever since. Why? Because mining is hard. It takes 10 years to bring a new mine online. You cannot just flip a switch. The easy silver has already been found. The grades are getting lower, The environmental regulations are getting stricter. The energy costs are getting higher. So even if the price hits $100 tomorrow, supply cannot react quickly. It will take a decade to fix the supply shortage. But the demand shock is happening today. This imbalance, this vacuum, is what JPMorgan saw coming. They did the math. They saw the solar mandates, they saw the EV mandates, and they realized there is not enough silver in the ground. To build the world, the politicians are promising. We have talked about JPMorgan, but they are just one player. There is a bigger game being played, a global game. And to understand it, we need to look east, to China and the BRICS nations. While Western investors have been distracted by the stock market, China has been draining physical metals from the West. For years, the Shanghai Gold Exchange has consistently traded silver at a premium over the COMEX price in New York. This is what traders call an arbitrage opportunity. Buy low in New York, sell high in Shanghai. This creates a vacuum effect, sucking physical bars out of Western vaults and moving them permanently to the east. Why does this matter? Because China dominates the solar panel industry. They control roughly 80% of global solar manufacturing. They know better than anyone that without silver, the green energy transition is dead on arrival. If they control the silver supply, they control the energy future of the world. But there is another layer: currency. The BRICS nations, Brazil, Russia, India, China, South Africa, and the new members, they have been openly discussing a new reserve currency, one that is not based on debt, like the dollar, but based on commodities, gold, oil, and silver. If they launch a currency, backed even partially by metals, the demand for physical reserves would be astronomical. Think about Russia. They are one of the world's largest energy producers, but they are cut off from the dollar system. They have been accumulating gold, and reports suggest they are looking at silver as a strategic metal, not just for money, but for war. Silver is crucial for military technology. It is in the guidance systems of cruise missiles. It is in the contacts of fighter jets. It is in the satellites that guide them. During World War II, silver was considered so strategic, the US government borrowed silver from the Treasury to use in the Manhattan Project. Because copper was in short supply, today, in a world of rising geopolitical tension, silver is not just wealth, it is national security. And right now, the West is running a deficit, while the East is accumulating. This is a transfer of power, disguised as a commodity trade. And on December 6th, when the price broke $59, it might have been the signal that the East is done playing by Western rules. Part 6. History repeats, but differently. Now, let me take you back to Texas, 1979. To understand where we are going, we must understand where we have been. Two billionaire brothers, Nelson and William Hunt. They looked at silver, trading around $6 per ounce, and they saw exactly what we are seeing today. Inflation, a weak dollar, and consumption exceeding production. It was a perfect storm, so they bought approximately 200 million ounces, around 1/3 of America's entire silver supply at the time. Then, January 1980 arrived. According to historical records, silver hit $49.45. That represents roughly an 800% gain in just 18 months. The banks panicked, the establishment panicked, because the Hunts were winning. So what did the system do? The COMEX changed the rules overnight. They banned new long positions. They said you can only sell, you cannot buy. Imagine playing a game of poker, and when you reveal a winning hand, the dealer says, "Sorry, winning is against the rules." Silver crashed. March 27th, 1980. Known as Silver Thursday, the Hunts were destroyed, bankrupted. But here is what I think matters most. The squeeze was real. The shortage was real. And the price was real. It literally took changing the entire game to stop it. Now, fast forward to 2025, imagine the same scenario. But this time, the buyer is not two reckless billionaires from Texas. The buyer is the bank. That helps make the rules. That might be what is happening right now. JPMorgan learned from the Hunt brothers. They are not going to squeeze the market too fast. They are not going to be reckless. They have the backing of the Federal Reserve. They have the backing of the system. Because they are the system. Who is going to change the rules to stop JPMorgan? Nobody. This is why I believe this run will be different. It will be sustained. It will be controlled. But it will go much, much higher. Look at the gold to silver ratio. Historically, for thousands of years, since the Roman Empire, the ratio of silver to gold in the Earth's crust is roughly 15 to 1. Today, even at $59, with gold trading at $4,200, the ratio is still around 72 to 1. Silver is mathematically, statistically, the most undervalued asset on the planet. If that ratio just returns to its historical average, just mean reverts, we are not talking about $59. We are talking about $280 per ounce. And if it overshoots, like it did in 1980, when the ratio hits 17 to 1, do the math. The numbers become staggering. Part 7, the macro endgame, the Fed's dilemma. But silver is just the symptom. The disease is the dollar, December 9th and 10th, 2025, 3 days from now. The Federal Reserve meets to decide on interest rates. This is the event everyone is watching. According to Bloomberg data, the current probability of a rate cut sits at approximately 87.2%. Why are they cutting rates? Because the economy is cracking. Commercial real estate has collapsed. Regional banks are on life support. The government interest expense on the $36 trillion debt is now higher than the defense budget. They cannot afford high interest rates. So, they must cut. They must print. They must debase the currency. This is the trap. If they keep rates high, the system breaks. If they cut rates, inflation returns, and the dollar dies. They have no good options. But for silver holders, both options are bullish. If the system breaks, people run to safety, gold and silver. If inflation returns, people run to hard assets, gold and silver. It is a heads I win, tails you lose scenario. Gold has already sniffed this out. That is why it is at $4,000. Central banks bought more gold in 2024 and 2025 than at any time in history. They are diversifying out of the dollar. They are preparing for a reset. Silver typically follows gold, but it moves with a lag. And then it acts like a slingshot. When gold moves 10%, silver moves 20%. When gold doubles, silver can triple or quadruple. We saw this in 2011. Gold went up, but silver went up 500%. We are seeing the beginning of that slingshot move right now. The Fed meeting in 3 days could be the spark that lights the fuse. The structural deficit is the tinder. JPMorgan's positioning is the accelerant. And a paper market under stress. Is the explosion all the pieces appear to be in place? Part 8, the conclusion. The window is closing. So, what happens next? Physical silver is still available right now, but the window is closing. Premiums are rising rapidly. Dealers are reporting delays. Some online bullion dealers are putting limits on orders. That is the first sign of a freeze. When the paper market truly breaks, when the price goes to $100, you might not be able to find any metal to buy. Or if you do, the premiums could be 100%. Imagine silver at $100 spot price. But the real price, the price to actually hold a coin in your hand, is $200. That is where we are heading. a bifurcated market, where the paper price is meaningless and the physical price is priceless. I am not a financial advisor. I cannot tell you what to do, but I can tell you what I see. I see a system that is out of time. I see a bank that has cornered the market. I see an industry that is desperate for supply. And I see a geopolitical shift that favours real assets. In 1980, silver peaked at $50. It took 45 years to break that record, 45 years of suppression, 45 years of accumulation, 45 years of coiling energy. And now, we are here, $59, and climbing. The dam has broken. The silver tsunami is not coming. It is already here. The water is rising. And you have a decision to make. Do you trust the paper promises, or do you trust the physical reality? The choice is yours. But think carefully, because history is being written right now. And December 9th is only 3 days away, if you want to follow along as this unfolds. If you want to know what happens after the Fed meeting, hit subscribe. I will be tracking developments and sharing my analysis in real time as we watch this historic situation develop. Do you think silver hits $100 in 2026? Or do we see 200? Drop your thoughts in the comments below. I am genuinely curious what you all think. This might be the most important financial story of our lifetimes. Thanks for watching, and stay safe out there.